How's it going, everybody? For those who are meeting me for the first time, my name is Ronnie Fogain. I am a Canadian and US CPA, and my number one goal is to help content creators across the continent build wealth through effective tax planning. Now, in the last video of the series, we talked about the first and easiest tax strategy pillar, which was deducting. The one I want to discuss today is going to be deferring. Deferring is one of the most popular, also one of my favorite tax strategy pillars, because it not only incorporates how we're saving on taxes in the present, but it encapsulates how we're going to be saving on taxes as a whole between now and the future. We're talking about the time value of money now. We're talking about inflation now. We're talking about concepts that go beyond just taking a deduction and reducing your taxable income in the present. The main premise of this tax strategy is we're not just looking at how much tax we save today, but how much tax we're going to save in our lifetime. And this means comparing two periods now. We're not just looking at the current fiscal year, we're looking at multiple years over time. Deferring at its core is the concept of not paying tax in the present when you should have legally. Naturally, you might say, what's the point of doing this? Because we're not really taking away tax, are we? We're just delaying it until the future. I don't want to delay things into the future. I want to get it over with right now. I might as well just pay it now. You are missing out on a chunk of the benefits that tax planning has to offer if you think this way. Example number one, we're going to hop right into our scenario analysis right now. First tax pillar, we had started with a Canadian example. With this second tax pillar, I want to start with a US example. Ben is from Nevada. Ben has a creator business that's thriving. All right, right here we're looking at his personal tab, and he's paying himself a regular salary of $50K. The key thing here is he has a corporation. He has a C Corp registered in Texas, and he is netting $1 million in revenue. Business expenses, we're going to keep the margin simple at 50%. So he has netted himself $500,000 in profit for the year. You know, he's been thriving on his creator business. The brand deals are hitting, the Twitch subs are rolling in, the AdSense is on fire. From our previous tax pillar where we talked about deducting, we know that on a personal side, tax rates are progressive and they can go real high. Federally, they can go as high as 37%, and we'll keep it this way because remember that Ben is in the state of Nevada, so he actually doesn't have to pay state tax in this scenario. You'll note that on the corporate side, though, his corporate rate is 21%. Now, we know already off of arbitrage, I'd rather be paying 21% tax than that high rate of 37%. And what Ben is going to do is he's going to implement the tax strategy pillar of deferring, where he has this $500,000 in profit, and instead of paying himself that and having it switch over to the personal side, he will hold it in his corporation because he does not need the excess. And he would rather reinvest that money into the business and have more after-tax dollars to reinvest into the business. It's one thing to say it to you guys, and that's what a lot of people on social media do. They tell you, hey, like incorporate. It's a whole different type of magic when I can quantify things for you guys, all right? So we have $500,000 that Ben is earning for the year. Ben is paying a flat corporate income tax rate of 21% on this $500,000, which results in $105K. That is the tax that he pays. So if we look at the combined scenario, so this is Ben personally and from a corporate perspective. We already discussed the corporate side where he's incurring $105K. Personally, he's paying $6,000 on salary of $50K. Combined, he's paying $111,000. Keep that number in mind, and I promise you in the next 10 seconds, you will see the power of deferring as a tax strategy pillar, because I'm about to show y'all how Ben could have had his whole tax situation all messed up. Let's hop back into our scenario analysis and tweak a few things. Let's say that Ben, happy with the year that he had, not really caring about any type of tax planning, not having a CPA by his side either. Ben is saying to himself, I made $500,000 this year. I want it all in my bank account. The business expenses are going to go up because assuming he pays himself a salary of $500,000, then he has zero profit in the corporation. So he's paying zero corporate tax. Now, the $105K of corporate tax is wiped out. From whatever platform you're watching on, I want you to leave the comments down below and be like, at this stage, at this timestamp, we're seeing $105,000 of tax wiped out. Are we thinking, oh, this is sick? Or are we thinking, hold on, there has to be a catch? Instead of $50K of salary, he has $550K in salary. And oh man, we are now seeing, if we look to our right, we are in our highest tax bracket at a personal level. We are not deferring our excess income anymore, and we are choosing to have the full amount taxable in 1 year. Ben is now in the second highest tax bracket federally. I'm talking about 35% of his income, right? And yeah, sure, he's in Nevada and he has no state income tax, but let's look at his combined situation: $162,000 in taxes. Let's go full cam on this and chat real quick. You guys just witnessed the impact of deferring income tax and the drawback of not deferring income tax. Deferring is one of the most important tax tools that anybody, not you don't have to be a CPA or an EA or an expert to understand these concepts. Anybody can implement these if they just have a long-term vision. It's not just about earning income nowadays. Anybody can earn income. It's about what you do with that income, how you choose to receive that income, and how you choose to maximize your wealth through effective tax planning. He went from $111,000 to 162. So he's saving 50K in taxes by leveraging the deferring tax strategy pillar. I'm going to stop right here because the video is getting long, but if you guys have any questions, leave them in the comments down below. Yes, it is also possible for Canadians to do this. We use a US example, but we're also going to make a Canadian example for the entire community to be able to visualize this. If you have any questions, leave them in the comments down below. And again, if you guys are meeting me for the first time, my name is Ronnie Fogain. I'm a Canadian and US CPA, and my sole purpose is to help content creators in our continent build wealth through effective tax planning. I will leave you guys right here, and I'll see you in the next video.